So Crown Castle. So Crown Castle owns, operates, and leases more than 40,000 cell towers, approximately 90,000 route miles of fiber, supporting small cells and fiber solutions across every major U.S. market. Okay. It's a real estate investment trust. So they are operating the infrastructure, and then I imagine they charge the communications companies like an AT&T, a Verizon, a T-Mobile. Hey, when you use our network, we're going to charge you at these rates, and that's how they make money. All right, and they also probably charge commercial networking fees or residential network, internet, charges and so forth. They get a piece of that. The kind of company that sells it to the consumer is going to be an AT&T, a Verizon, and so forth. But if it's handled on the infrastructure that these guys own, they participate in the revenue share that company is getting. So these guys are down a little bit today. It's been down for the 5-day, down for the month, and down 18% for the year. I like this space. I think they're smart to go into an infrastructure that's a necessity, right? Internet, communications, and so forth. Very smart. It's a $40 billion market cap company, $6.5 billion in revenue. P is a little high. This is a real estate investment trust. And over the 5-year, down 32%. That's a surprise. Needless to say, especially during the COVID years, boy, did we need internet. We needed internet to do everything, to go to work, to have our kids go to school, to just do everything, communicate with loved ones because we were completely socially distanced. So that is interesting that the stock's down. Analysts say it's a hold, but it's discounted. And now with real estate investment trusts, I don't look at free cash flow because I think a real estate investment trust, they have certain rules where they have to distribute a good part of their earnings to stockholders. In this case here, they pay a nice dividend of 6.8%. So that looks pretty attractive to a person who wants income from their stocks. Now let's take a look at their revenue. Now the revenue, as expected in these years, it was growing, and then it stopped growing in 23. And looking at the quarterly, it looks like the worst quarters are behind them. And the most recent quarter, it was pretty flat. It was only down 0.9%. But I think that's what the story has been over the last, call it, year and a half or so, that, revenue stopped growing. So what is going on? So you have rental revenue. Okay. Bear with me. I'm just trying to get my head around their financials, and then I could kind of share with you what I'm seeing. So funds from operations is what the company looks at, and they have to distribute a certain portion of that funds from operations to stockholders in the form of dividends. It looks like their funds from operations is going down a little bit. It's still pretty strong, but it is going down. And they're paying out a good percentage of it. You can see that more recently, their funds from operation have dropped. They've held their dividend rate the same, so it's a greater percentage of that funds from operations being paid out. So this one here, I think what I would do, I own one REIT, and that's CTRE. I'm okay with that one REIT. I don't think I want to buy any more REITs. But this company, if I felt like, hey, they're going to start growing their revenue, they have a new venture or a new idea that's going to improve their business, then I'd probably be interested in the stock. If it's going to be the same old kind of, nothing's going to change, I don't know that I would own the stock because what they've been doing has not been working. So I would want to understand, what are they going to do that's going to change this and get them back to their stock price being, around $200 per share. I think it's the right space to be in. It's not like, hey, they're in, like commercial REITs that own office buildings. Boy, they had a tough couple of years with employees wanting to work from home. So these guys are not in that space. They're in a space that I think is in high demand and should continue to be in high demand. So I would probably study the company. For me, I like the space. It's a quality company. And it might be a good rebound story. I'm not looking for another REIT, so I'd probably pass on keeping it on my watch list. But I could see that this is an idea to chase down and see if it's a good investment. So good luck with that, Mike.